Okay, this is Managerial Accounting 2242, and this is an overview of Chapter 2. So when you're looking at the types of businesses, there's typically three main categories. A service company, think about like an auditing firm, a law firm, engineering, architects, that type of thing. Merchandising companies, Walmart, for example, and then manufacturing companies, so that could be car manufacturers, for example. So with manufacturing companies, when you're looking at the manufacturing side, you've got three inventory accounts. You have your raw materials, so that's, say if you're making desks, that would be the wood that you're buying to make the desks. Work in process, so if you're making some desks, maybe by the end of the year, you've got several desks that are partially completed, so we'd call that work in process. And then finished goods, you finish making a product, but you haven't sold it. So these are three inventory accounts, and they show up on your balance sheet as an asset. Another common term you hear in the business world is the value chain. So this value chain takes you right through from the research and development to making the product, marketing it, and just continuing on right to the end of the process. When you're manufacturing products, you have both direct and indirect cost. So a direct cost is one, as the name would apply, can be easily and directly traced to the cost object. So if you're making a desk, the wood that goes into the desk can be traced. Whereas an indirect cost is one that can't easily be or directly traced. So you think about the small nuts and bolts and whatever that go into a desk. It's, these are like indirect costs that you don't bother to trace. It's not worth it from a cost point of view. So here, continuing with our desk example, so if a manufacturing company wants to determine the cost of the desk, they're going to add up all your direct costs, so it means your direct material, such as the wood, all the direct labor, so the employees are actually involved in making the desk. Then you have your indirect costs, so indirect materials like oil for the machines, you have your factory manager salary, and other costs of running the factory, such as rent and utilities. So these are expenses you have to have, but you can't necessarily trace them to individual products. So when you are looking at assigning your cost, you can trace your cost. Your direct costs can be traced directly to the product that you're making, whereas indirect costs, you're going to allocate or kind of average it out over all of the products that you're making. So it's important as well to recognize that some costs can be direct or indirect. It depends on the cost object. So if you're making an aircraft, some of the cost of the manufacturing facility would be indirect, whereas if you're looking at, if your cost object is the plant, then all of the costs related to the plant become direct. So period cost also continue along the value chain. So period cost versus product cost is the next category we want to look at. So here, when you're looking at period cost, you have a situation where for a service company, there's no inventoriable product cost. You don't have inventory, obviously you're providing a service, so all of your costs are period cost. For a merchandising company, the purchase of your merchandise that you're buying to resell, so the merchandise plus the freight in means the cost that you pay to have it shipped to your store, and any customs and duties, all of that, it's in a part of the cost of the inventory that you're selling. And then all of the other costs such as salaries, depreciation, insurance, property tax. They would be period costs. And the final category, a manufacturing company, it has, the more complex inventoriable costs. So it's got your direct materials, your direct labor, and then your manufacturing overhead, which include indirect material, indirect labor, such as the factory supervisor, etc. But for manufacturing companies, they still also have some costs that are period costs. So these costs occur all along the value chain. So it was, the cost of research and development, for example, would be a period cost. So when you're looking at the cost of a product, depending on what you're using the information for, it can differ. So the total cost is what you use internally. So when you're calculating the cost of a project to make internal management decisions, you want to capture all of the costs for making that product. Whereas when you're preparing your year-end financial statements, only inventoriable product cost can be assigned to the product. So you have to think about what you're using the information for. So if it's for internal management decision making, you want to know all of the costs. Whereas for external financial reporting, it's only the inventoriable product cost. And all of this will become clearer as you practice various problems. So the product cost of manufacturing, so understanding how these costs are incurred and how they're assigned, this is a very important topic for this chapter. So as we mentioned before, your product cost is your direct material, your direct labor, and your manufacturing overhead cost. So when you're looking at your prime costs, that would be direct materials, direct labor, then conversion costs, this would be the overhead and the labor required to convert the materials into a finished product. So when you're comparing the balance sheets, a service company is not going to have inventory. Merchandising company, like a Walmart, would have merchandise inventory. A manufacturer would have three categories of inventories. The raw materials, so back to the desk example, they would have some wood in stock to make their desk. Work in process, these are desks that are partially complete, not quite finished. And then desks that are finished but are not sold. So they have three categories of cost. And a lot of the problems in this chapter revolve around the manufacturing cost because it is the most complicated one. So for a merchandiser, if you're calculating your cost of goods sold, it's pretty straightforward. You have some beginning inventory. Think about, Walmart again. Obviously there's inventory at the beginning of the year on your shelves. Then you're going to be buying more products to sell. So that's the total goods available for sale. Then you want to figure out how much you sold. So to figure that out, you calculate your ending inventory. So you subtract your ending inventory, and that will give you your cost of goods sold. So it's beginning inventory plus your purchases, tells you how much you have available for sale, subtract your ending inventory, that gives you the cost of goods sold, which you would then deduct from your revenue. Now, with this slide, you can see that calculating the cost of goods manufactured is much more complicated because you have to calculate your three inventory categories. But they're all calculated in the same way. So for raw materials, it's the materials you have at the beginning, plus your new inventory that you've purchased, gives you how much you had available for sale, less your ending raw material inventory, tells you how much raw materials you've used. The work in process, you start off with the beginning work in process inventory. You add in your raw materials, your direct labor, and your overhead. That gives you your goods manufactured. Then you subtract your ending work in process, will give you your cost of goods manufactured. So to get to the final category for finished goods, same idea. You start off with your beginning finished goods plus what you have manufactured, which you calculated there, your cost of goods manufactured, less your ending finished goods inventory, and that will give you the cost of goods sold. So to get to that cost of goods sold, you have to do the raw materials first, figure out how much you used. So then you add that in over here to your work in process. That will give you the cost of the goods that you manufactured, which you would bring over here to your finished goods. So it's important that you really pay attention to these examples and make practice problems for the cost of goods manufactured and cost of goods sold, and also make sure you look at my demonstration video that I have in the file folder for this module. So when you're looking at costs, not all costs are relevant. So any costs that have occurred in the past, they're called sunk costs. So if you are trying to look at a future decision, all that matters really is the future costs and costs that can be controlled. If the costs can't be controlled, like property tax and leases and things like that, then that's irrelevant to your decision. And again, in the chapter we'll cover various problems where you can see the impact of relevant or irrelevant costs. So another important category to really keep in mind when you're reviewing this chapter is fixed costs. So fixed and variable costs. So fixed costs is a cost that stays the same over a wide range of activities. So if you're thinking about car insurance, it doesn't really matter how many miles you're driving, whether it's 1,000 miles or 10,000, your insurance cost is not going to be any different. It's going to be, $1,300, $1,400 or more a year, regardless. But variable costs, these are costs that change in direct proportion to changes in volume. So here, if you're looking at the total gasoline that you're paying for, obviously you're going to be spending less if you only drive 1,000 kilometers versus 10,000 kilometers. So that's a variable cost. So when you're looking at manufacturing costs, materials, your direct materials is variable, your direct labor is variable, your manufacturing overhead, that's a combination of fixed and variable, because some of it is fixed. You think about the insurance, your property tax, etc. And then some of it is variable, like some of the oils and small parts used to support the manufacturing process. So you have all of these add up to inventoriable product costs, and it's a mixture of fixed and variable. So that concludes the overview of the chapter 2.